The big thrust in my career as an investor is how do we actually bring the strength of the Western capital markets to bear on this problem of rebuilding the physical world.
Today I'm sitting down with Brett Bivens. Brett is an active angel investor that invests across new industrial technologies and next generation infrastructure. He is also the founder of Production Capital, which he's currently getting off the ground, that's going to focus on providing non-dilutive funding to newer industrial technologies.
Production Capital represents a fusion between sort of an investor mindset and a builder or technologist mindset.
Now, Brett has thought a lot about how we're going to finance this kind of new industrial deployment age. And about 5 months ago, he put out a great piece called the Production Capital Mosaic, where he laid out a variety of financing models that are coming together.
We're in the early days of a capital supercycle that's really aimed at rebuilding Western industrial capacity.
In this episode, we walk through each one of those in his piece. Hope you enjoyed the episode, and remember to go direct. We are live. What's going on, Brett?
How are you? Good to see you. Good to be here.
You too, man. Everything's good. Well, listen, before we hop into new models of Production Capital, it's not often that I get to speak with someone who, with a French spouse, spends a lot of time over in Europe and talks a lot about the new industrial age that we're going through. So I'm excited. It might be a little bit of a confirmation bias conversation today, but I'm excited to dig through it.
Yeah, I think we've got a lot in common, and hopefully we can find some areas we disagree as well.
Exactly.
To kind of push the envelope a bit or push our thinking.
Cool. All right. So before we hop into it, for everyone listening or watching, so obviously the whole premise behind this going direct is how can we decentralize the real economy, and decentralized production is the core, kind of the heart of this new system. And in order to do that, we're going to have to finance completely new, we have to find new ways to finance next gen infrastructure that combines both hardware, software, AI, robotics, all the emerging technologies. And it's going to require some pretty interesting funding models over the next several years. Many will normalize, but I think there's going to be kind of new areas to explore. And Brett, I know this is something that you think a lot about and what you're building in. So just to frame it up, Brett kind of on his website talks about building and investing in new production models to finance a new industrial deployment age. And why we wanted to have this conversation today, which is really about a piece that he wrote back in May called the Production Capital Mosaic and financing the new industrial deployment age. And so that's going to kind of be the frame for the discussion. And we're going to walk through, kind of get in the weeds here. But I want to start here and let you kind of explain. So I'm going to read from the piece. You define production capital as financing the emerging physical technologies aimed at transforming critical industries like energy, aerospace, defense, manufacturing, materials, and transportation. So I think it's I know you think about this stuff all the time, and say as well as do I, but most folks don't. So it'd be great just to kind of provide a framing towards this new industrial deployment age and, production capital.
Yeah, I think there's really two sort of core things happening. So the first is that, as a result of, you can call it great power competition, you can call it sort of deglobalization, whatever sort of macro lens you want to put on top of it, we're in the early days of a capital supercycle that's really aimed at rebuilding Western industrial capacity. You look at figures coming out of the McKinseys of the world, of the BlackRocks of the world, as you sort of alluded to, there are going to be tens of trillions of dollars pushed into rebuilding a physical infrastructure, rebuilding the industrial economy over the coming decades. And, companies increasingly committing to long-term rebuilds of their own kind of production capacity and supply chain relationships. And so what's happening is, capital is mobilizing, demand is increasingly urgent. But there's sort of a critical question that we haven't answered. And that is, how do we actually go and build this? So we have these persistent structural labor scarcity issues across the industrial economy. our workforce is aging. We're not training the next generation of people to come in and fill these jobs. There was an article, the other day, or an interview the other day with the CEO of Ford talking about how millions of jobs are sort of going unfilled in the industrial economy. And, at the same time, we have kind of proven over, decades now that we lack the capacity in the United States, in Europe, in Western economies generally, to build these large, centralized infrastructure projects. And so I think that's kind of the overhang across all of this, which is there is going to be a ton of capital pushed into these categories. There is going to be a ton of a sort of regulatory push or policy level push to rebuild, the way that we produce energy, to rethink the way that we manufacture, to reorient supply chains. And, right now, the capital markets that need to sort of flow that top-down capital through to the companies, to the technologies that are actually going to go out and execute that, remain extremely siloed. And so that is kind of the big push, or the big thrust that I've been on now for several years in my career as an investor, is how do we actually bring the strength of the Western capital markets to bear on this problem of rebuilding the physical world.
Okay, and so it's a good segue to the other side of the coin, right? So, but when we're talking about the new physical world, it's obviously as many probably realize, we're obviously in the middle of a very transformative time from a technology standpoint. And so, you cite Carlota Perez's work a lot in kind of around technological revolutions and what we're going through right now, which is kind of the reason why this new type of production capital is new models are going to form and be needed. So can you just talk a little bit about who Carlota Perez is and how it's really influenced your thinking around where we're actually at from a technology and economic standpoint? Yeah,
definitely. I mean, that is kind of the, if that macro piece, that's the top down, the technology elements and the sort of technology building blocks that underpin this are really the bottoms up sort of momentum that is actually making it possible for us to kind of bring these worlds together. And so Carlota Perez is an economist. She has written extensively, including in the book that you referenced, about sort of technology cycles and financial cycles and how they work together, and has been able to sort of go back and trace large economic transformations and sort of showcase that they go through a relatively predictable pattern. It starts with sort of early technology development of whatever sort happening amongst very small groups of innovators in very geographically concentrated locations. That starts to build momentum. It leads to sort of irrational exuberance. It leads to speculation. It leads to a lot of financial investors coming in and looking at these new technologies and, thinking that they're going to, change the world, change the economy. These are sort of the classic bubbles that we all talk about, that we're sort of, everyone's thinking about right now as well. And at some point there is a turning point that can be brought on by crisis or by some sort of breakdown that allows a sort of resetting, a move away from sort of this speculative capital towards a world that she frames as production capital, which is essentially capital that is focused on driving these new technologies into the real economy. So into a more distributed sort of geographic footprint, into the places closer to where it can actually be used by real industry. And so where we are today in that, and it's always risky to try to predict exactly where you are in any given cycle. And so I won't necessarily try to do that. I will say that we've had, so many potential sort of turning points over the last decade: health crisis, supply chain crisis, warfare, all of these things that are, forcing a realization that the technologies that have been developed over the last, 40 plus years that are now converging do actually have tremendous potential to make their way into the physical economy and not just sort of stay in the quote technology industry, let's say. And so those technologies, whether it's artificial intelligence, whether it's better better sensors, whether it is sort of persistent connectivity that's driven by things like Starlink, whether it is the sort of hardware innovations and even a lot of the biotech innovations that are now all kind of coming together to make it possible to do all the things that you care so much about around decentralizing the physical economy and changing the way that we produce and changing the way that we get these products and these solutions into the hands of users, of customers.
Great. So what I'm bringing up here are what I want to, which is what we're going to spend most of the time on today, is kind of going through these new production capital models that Brett lists out in his piece. And so I'm just going to read it off just for folks that are listening, but there's kind of two categories here, which are things shaped like an investment firm. It's category one. And then kind of category two, things that are more shaped like an economy. And under the first column, things shaped like an investment firm, we have venture, capital markets, connectivity, growth, and project capital, modern merchant banks, SPACs and pipes, venture turnarounds. And then things shaped like a company, techno-industrial holding companies, digital capital markets orchestration, growth buyouts, super developers, industrial franchises, and DePIN projects. So there's a lot there. We're going to go through kind of one by one, but I just wanted to frame that up. But Brett, before I do that, there was something I wanted to drill in with you, which I thought was very fascinating. You use this term mosaic as you think about kind of framing all these new types of financing models. And you had a quote in here, which I thought was very interesting. I want you to break down for us, which is, it's composed of cells of two genetically different types. You have the role, which is the founder financier. You have the funding type, which you have both kind of venture capital and infrastructure. And then within that, you have both in the physical world and the digital world, because it obviously touches both. So can you just break this down a little bit? Why mosaic? And what do you mean when you say this is composed of cells of two genetically different types?
So there's the famous quote, and I can't remember who to kind of precisely attribute it to, but the sort of quote of, there are effectively two ways to make money: bundling and unbundling. So I guess another way to think of that would be sort of, centralizing things, bringing things together, and then, building a more sort of diffuse and decentralized model for value creation and value capture. And I think if we even take a step back and look at sort of, some of the historical parallels to, moments in time where there were really transformative shifts in really large industries or large parts of the economy, I think we see some similarities to what's happening here today. And what's happening here today, as you sort of alluded to, are sort of these silos that have, I think, defined the way that we think about whether it's company building, whether it's capital allocation, these sort of very clean cut lines. Like this is a company, this is the founder of a company, this is an investor, this is a capital allocator, being very separate. And I think what happens in these moments in time when, we are going through these big transformations is that those two worlds come much, much closer together. The sort of silos of the capital markets, let's say the infrastructure funds or the private credit funds or the venture capital funds, like those are highly evolved models that have been built up over time and have become super, super efficient at being very legible to large scale capital. And I think a lot of the things that are going to kind of spark the industrial transformation that we hope to have over the next couple of decades are, in their current form, not hyper legible to large scale capital in a lot of cases. And so they end up looking like, and the people that are building them end up looking like interesting hybrids of, technology entrepreneurs and investors, or software developers and, physical technology developers. And so there is sort of this blend between these disciplines and this, kind of convergence of culture that I think needs to happen in a lot of ways. And maybe, as I said, I was going to go back in time a little bit and maybe just to draw a bit of a line to something that, people probably understand, or at least a lot of people have kind of experienced a little bit in their life cycle or their lifetime, is, what happened in sort of, call it the 70s, 80s in the shift from broadcast television to cable television. and people like John Malone from TCI and now Liberty Media, who, kind of saw this new opportunity emerging, saw this opportunity to go from 2-3 kind of main broadcast channels to this new type of infrastructure, this new type of connectivity, this new type of programming that was going to allow hundreds of channels to sort of bloom, and all of these different regional television and cable operators to bloom. And what John Malone ended up building was a company that looked a little bit like an investor, a little bit like an infrastructure developer, sort of building out the cable around the country, and kind of fused those two things. And so I think, that sort of backstory, or that example, which is very far from, what we maybe think of as the traditional sort of infrastructure and industrial stuff that we're talking about and looking at here today, is very sort of, relevant or very closely tied to the way that a lot of these firms are being built, or a lot of these companies are being built, which again is sort of by blending multiple disciplines, by, being able to figure out how to merge multiple cultures that traditionally have been sort of incompatible, or at least have been separated inside of a single organization.
Yeah, I mean, you think about it, I heard another way to reiterate kind of another way of saying it, which was, in our lifetime, essentially, when you think about Silicon Valley and the technology coming out of Silicon Valley, obviously the last cycle being very software focused, Silicon Valley's never needed Wall Street. Mm-hmm. And so now Silicon Valley needs Wall Street. And then Wall Street never really interacted with the Silicon Valley, obviously when companies go public. But I think to your point, I use that analogy, something people can understand, where just like there's this melding and mixing going on. And so on that point,
and I would say Washington, D.C. as well. I mean, obviously,
Sure.
Silicon Valley has its roots in sort of defense and government related projects, but for many, many years, many decades, that kind of connection was sort of lost. And so it is about kind of rebundling these centers of power and these centers of talent and these centers of resources to actually sort of drive these projects forward.
Yeah. So I'm on this point, and then we're going to get into the production models. We'll dig into those. You also have a quote in here. This is another Carlota Perez quote. And I think this is really important for people to understand, because I think it as the underpinning for what you just explained, which is, and this quote is actually, is on what is called the entrepreneurial nature of production capitalists. So obviously folks that are focused on applying new technologies to create for a more production oriented economy into the real economy. And it goes this, and here's the quote, and then Brett, I'll turn it over to you. So financial capital can successfully invest in a firm without much knowledge of what it does or how it does it. Its main question is potential profitability, sometimes even just the perception others may have about it. For production capital, on the other hand, knowledge about product, process, and markets is the very foundation of potential success. So talk to me about why that was included in your piece and why that's important.
That quote, I think, sums up in a very, very crisp and concise way what I was trying to get across just a second ago, which Sure. is, again, that if we're in these markets that are defined by sort of speculation and financial capital, and are really about how do I, invest in something today or deploy capital towards something today that somebody else is going to pay me more for tomorrow. And that is kind of my only sort of context, or my only understanding of how the market actually works, or how the underlying technology actually works, is that there is some sort of narrative that is flowing through this market. And I understand the narrative enough to know that if I'm early to this, somebody else is going to kind of, mark up my position, or mark up my investment, or be the bag holder in the next wave of this. And, I think what Carlota is getting at with sort of the production capital component is very much that in order to invest in these areas where there is a tremendous amount of complexity, because it's not just about building the technology. To your point, it's also about sort of how do you access and understand the sort of capital markets that are going to, drive this forward, because it's more than just sort of pure equity investments. How do you understand the policy landscape? How do you understand the distributed nature of the customers that are going to be, using this product or using this solution? I think that's what she's really getting at there, is that production capital represents a fusion between sort of an investor mindset and a builder or technologist mindset.
Do you have any other examples that you like to, I know you gave kind of the John Malone example a little bit, but anyone else that like to put it in maybe from the last, I guess, production capitalist wave that you like to cite, just to give another real world example?
Well, I mean, I think going very, very far back, and then I'll maybe move towards the current times. I think that the early sort of American merchant banks, let's say late 18th century, late 19th century, early 20th century, the JP Morgans of the world, the Brown Brothers of the world, sort of these organizations that, were sort of pre asset classes, let's say. These were kind of firms and people that were saying, okay, there is this huge industrial opportunity, whether it's in railroads or maritime shipping or, industrial production of some sort, steel production, and basically saying, look, we're going to commandeer the resources financially and politically and from a human capital perspective and figure out a way to drive those into these businesses. And, there was less of a concern, again, about what, necessarily the asset class was, because these groups were extremely powerful and had all the resources at hand. And so I think that is, a very old historical example. I mean, look, I think today, even the firms like Andreessen Horowitz, the venture capital firms, these sort of large mega funds have gone a long ways in that direction because they've sort of realized, and they're obviously all playing the game to some degree of, hey, we are still in some markets in a phase of exuberance, in a phase maybe of speculation. But in other areas, they've very, very deeply understood the need to more deeply integrate the portfolios of technology companies that they're building with the power centers in Washington, D.C., or the sort of capital pools on Wall Street. And so I think Andreessen Horowitz is a fantastic example of doing that from a regulatory or a policy perspective. And I think another one is a relatively new partnership between 8VC and Apollo, which kind of also plays that role of saying, hey, we know that there is a world beyond just pumping more venture capital dollars into these businesses that are building ships or, building energy infrastructure or building manufacturing capacity. We know that to really scale and meet the ambitions that these founders have for these businesses and build the foundations to be lasting, durable parts of the industrial fabric, we need to bring to bear the expertise and the resources that larger firms have. And that's a realization that is shared both ways. The 8VCs of the world saying that they need more of that access to that type of capital, and the Apollos of the world, looking at sort of the emerging companies coming up and believing that with their resources, with their capital tools, they can actually scale these businesses in a fundamentally new way.
But I want to get your opinion on this, because I have. So we're really talking about the capital side, but we're not talking about the demand side for the capital, mm-hmm. which is having enough interesting technologies and entrepreneurs really going after it and looking to transform these industries. So do you find, like, to me, it comes across just from the work that I do in my angel investing and the folks that I speak with, that there's no shortage of capital. It's really a shortage of interesting teams, top class teams going after really hard, interesting problems. I don't know what your thoughts are.
Yeah, I think that's largely true. I mean, I think on the capital side, it's not an amount of capital problem. It is sort of the way that it's packaged and the way that it's delivered. And so I would say that's the challenge there. And then I think you're exactly right. We've struggled again as a whether it's the venture capital firms or kind of as a broader technology industry to get companies to the point where they are ready for that large scale capital, where they can credibly walk into a KKR or Apollo and show that they can be, good borrowers, or that they can actually execute these infrastructure projects that they say they're going to develop in order to get their technology out into the world. And so I think that is another example or another reason why so many of the, I would say, most interesting initiatives or efforts that are taking place here do really sit at that intersection of, or that sort of collection of, teams that have the technology expertise, the capital expertise, the, putting the steel in the ground, project development and execution expertise, and the sort of regulatory and policy knowledge as well to understand how to navigate these highly regulated worlds. And so I think that's hopefully a lesson I would say that has maybe been learned over the last decade or couple of decades, is that, just building technology or just focusing on that in a silo is not nearly enough to actually get a company to the point that it is ready to really scale and to really be a grown-up industrial company.
Yeah, it's interesting. I find this all the time. Obviously, I'm from Detroit originally, and spent a big part of beyond my growing up there, a big part of my career there. And it's very interesting when you think of, when you talk to technologists and folks out in the Valley. I spent a few years out there at the beginning of my career. They're not used to having to deal with these real, like the problems of the real world. When I mean the problems of the real world, like how people act. And so I think the perfect example of that is kind of the pushback. I'm not saying whether it's warranted or not, but kind of AI has a big narrative problem, especially with these data centers, right? Where it's like the folks that are building this technology, they haven't got out in front to like go actually educate the communities where they want to build these. And it's a real thing, going back to your point. And I think once you get the real world involved with this, it just creates so many more variables and complications. So anyways, so I thought I wanted to use that example because I saw it happen all the time in Detroit, where folks would come in trying to build a project, do X, Y, and Z. They wouldn't engage anyone in the local community. And a lot of times things would get blocked. And I'm not saying I agree with or disagree with it, but it would just get blocked because no one took the time to like sit down with residents of where they wanted to build the thing that would affect their lives,
Yeah, and we're both from Michigan. I'm from Battle Creek, Michigan, which isn't the like automobile city, but is the cereal city. So it's food kind of manufacturing and processing plants. And I don't know if we're necessarily going to go back to a world of these sort of company towns like the town that I'm from, or the place that you're from, or so many of these sort of now Rust Belt type of cities and towns across the Midwest. But to your point exactly, the companies that at least that I've had experience working with that have had sort of the most success in building, this type of infrastructure, these types of projects, actually getting what they want to do off the ground in, the different locations that they're doing it, are the ones that have invested aggressively in building those relationships with local politicians, with local economic organizations, with local talent organizations, and with just the broader community overall. I think that's a fundamental part that's highly underrated when you're sitting, somewhere very far removed from that, simply building technology, or of course the other versions of that, right? Like there's the Silicon Valley version of that. There's also the Wall Street version of that doesn't have the right level of on the ground context. And there's the Washington version of that as well. And so there are these sort of, not to oversimplify it, but if you sort of need that Silicon Valley mindset, that Wall Street mindset and expertise, that Washington mindset and expertise, and that sort of on the ground relationship building, project building sort of capability in house. And that's a lot. That's a big lift for any sort of early stage company or any investment firm that wants to, service those types of companies that are going to need all of that expertise. Like that's a tremendous lift. And I think that's probably why, to your point, we haven't had this supply of companies that have fully been able to kind of build themselves up to that point where, where they can sort of hit that inflection level and actually execute across all of those areas.
Yeah. I mean, I think what you just hit on is, I would say you distilled down what going direct is all about right there, right? Which is if you speak. So it's been very interesting through this process. It's the first few months that I've been doing this consistently. and you speak to folks in the traditional venture capital space or even entrepreneurs building these technologies that are these more kind of decentralized production models or technologies to enable decentralized production. What's interesting is, especially on the investing side, people aren't dogmatic about decentralization generally, right? They're just like, hey, this is where our centralized systems have become too sclerotic. These new emerging technologies are coming to build a really big, meaningful business. And the reality is, I'm not judging, but the reality of it is they don't really, at the end of the day, in their mind or how they think about, because it's not their job. Their job's to deliver the best risk-adjusted returns to their LPs. They're not really thinking about, and from an intentional way of how that affects specific local communities, how that gets us more connected to products we buy and people that make them. It's, I don't know, there's something, it's a complicated thing, but I think what you're getting at, which is which I didn't think of it this way, which is like very interesting. This idea of these new models of kind of production capital to help solve some of those items, to how you can get kind of Silicon Valley, Washington, DC, and New York or Wall Street and Main Street all working together in a coordinated way, which is like very difficult. But I think I would say this, man. I was obviously the whole Munger quote, right? Show me the incentive, I'll show you the outcome. But I think that's kind of what's missing is if we can create more of these models with the right incentive structures to do that, that is what I see is missing.
Mm-hmm.
Yeah. If you're just if you are a GP of a fund and you're deploying capital, you typically have one incentive, and that's to earn the best return that you can for yourself and for your LPs, and return that capital and do it again. But okay, let's hop into the production capital models. You ready?
Yeah, let's do it.
All right. So we'll start here. And just full disclosure for everyone, obviously, and Brett even writes it in the piece, like this is kind of, which I love about it. It's kind of consistently forming and refining. And I think that's why I use this term mosaic. And so some of this is not very defined, but I want you to kind of walk us through where your head's at on each one of these. And there's a couple I want to dig further into, but I'll pass it over to you. So the first one, under the category of things shaped like an investment firm, you have venture and capital markets connectivity. What does that actually mean?
So there's a lot of talk in the kind of the broader venture ecosystem about this, call it a bifurcation of the types of firms that exist. There's the large, massive mega funds, and then, maybe there's room for, a bunch of these smaller firms running around and being specialists on geography or technology or some area, and they're basically feeding these companies to up the chain to these bigger venture firms. And so one of the areas that I think becomes really, really valuable for these smaller specialist firms to build out in terms of expertise and relationships is downstream access to capital markets, and not just the way that venture capitalists have traditionally thought of it, which is like, I'm going to invest in the seed round or the Series A round of this business, and then I know all the VCs that are going to do the next round. And so that has been sort of the extent of the capital markets relationships that venture firms have. And now as we look at what I believe is a massive opportunity to bring credit and to bring emerging kind of infrastructure capital and even sort of government capital in the form of grants or subsidies earlier in the life cycle of these companies to sort of help build these financial foundations, it creates a really big opportunity for a small set of firms to become specialists in helping companies do that specific thing. Like if we think about venture firms or companies building their cap tables as sort of a bunch of options. Like, okay, I'm going to get all these investors involved in my business because this person can do this and this firm can do this and this firm can do this and I can call on them as needed. That becomes a very valuable sort of option or capability for those companies to call on if their venture firm is out in the market really understanding exactly what that next phase of capital needs to look like for that business, understanding all the sort of core benchmarks and all the things that company needs to be prepared for, and then actually building the relationships to help them go execute on it.
So would you say, just to make it more concrete, because what you just described to me is, I believe like it's what Andreessen Horowitz seems to have done so well. And obviously they were very early on. Would you say that's like an example of it where they're building so much infrastructure and relationships, not only to help the early stage companies like operationally, but also on the capital market side?
Yeah, that's a good example for sure. Another good example that is more in this, like, call it specialist camp, is a group called Overlap Holdings, which is really focused on doing that exact thing, kind of working with these businesses that are going to have sort of diverse capital needs very early on in the life cycle, investing in them, getting on the same side of the table as them, and then being sort of their in-house, or I guess, external capital formation, capital markets expert. And that is, so there are some of the larger firms that are doing that exceptionally well at scale, and then there are smaller firms like Overlap that are doing that in a much more targeted way.
All right, great. Let's go to the next one. You have what you call kind of gap capital, which is a growth and project capital. So unpack that.
Yeah. So the sort of framing there, and I talked earlier about the challenges that we've had in the West in building sort of large scale centralized infrastructure, or, the challenges that companies who are, focused on the technology have in actually getting their, first commercial scale projects built and coordinating all the complexity that comes with actually going from, technology development to large scale technology deployment. And there are, several emerging firms, including a firm in New York called the New Industrial Corporation, which have sort of carved out this piece in the capital stack in between sort of venture and large scale infrastructure, and basically saying, we're going to invest in your business, very similar to the Overlap model. We're going to invest in your business, get on the same side of the table as you, and then play the role of being your active infrastructure developer, because we know that you're an exceptional technology company. You've got these big ambitions, but you may not know what great looks like in terms of actually going out and getting a project to shovel ready, or getting all of the capital that needs to come around the table to actually get that project built, or to sort of structure the offtakes in a way that makes the project financeable and bankable to large project financiers. And so that's another model of it, which is saying, still staying and keeping that exposure on the venture side, and then the sort of value add piece being active infrastructure development on behalf of those companies.
Great. This one I'm really interested in, because I've thought a little bit about it, but modern merchant banks. So explain first what a merchant bank generally is. And when you say kind of, how do you think about this piece as it relates to kind of the new industrial age?
Yeah, when I think about a merchant bank, and I suppose there are probably many definitions, maybe there is a very specific definition of what a merchant bank is, but when I think about, what a merchant bank is in my head, I think of what a group like Allen and Company does, which is essentially serve as a trusted, high value partner to entrepreneurs and to companies as they try to navigate everything from capital raising to mergers and acquisitions to even, things in kind of legal and regulatory realms. And so it's effectively saying, we're not going to go raise a fund. We're not going to go raise a venture capital fund, or we're not going to go raise an infrastructure fund or a credit fund. We're simply going to, commit to being active owners, active partners in these companies, bring sort of highly bespoke advice and highly bespoke sets of resources to help these individual companies and these individual founders excel and succeed. And I think the reason that that's such an interesting model in this current environment with this set of companies is that in most cases, there's no sort of standard template. There's no kind of like, hey, this is exactly how you build and scale a SaaS company. And here's all the metrics that you have to hit. And now that you have this much revenue, here's the exact person that you need to go hire. Like, these playbooks are sort of being built in real time for a lot of these businesses, which is not to say that there aren't sort of models that you can look at or people that have done it before, but it is a little bit more sort of one-off and hand-to-hand combat in a lot of ways. And so being an organization that can sit there and again, sit on the same side of the table as the founders and say, we're going to invest in your business. We're going to be very opportunistic in how we do that. And then we're going to go out and kind of command those resources, build the relationships, build the network, and provide you that trusted advice over the life cycle, I think is something that is, super valuable to a lot of companies at that early stage as they start to think about really figuring out what great looks like in those areas that they might not know what great looks like yet.
Cool. SPACs and pipes.
Yeah, I mean, we've sort of been through one SPAC cycle. I don't know if that will necessarily be a sort of critical piece of how this next wave plays out. The one thing that I am kind of interested in there is like going back to our kind of Main Street, piece of this. Like, how do we make it possible for people across the economy, not just sort of venture capitalists, not just angel investors, not just sort of insider financiers? How do we make it possible for the sort of, normal sort of retail investor to take advantage of the upside of these businesses and be a part of that growth story and that equity story? And so to the extent we can do a couple of things. One, build the financial foundations for these businesses earlier on in the life cycle by bringing better forms of capital to them so that they can become, again, these grown-up industrial businesses a bit earlier on and aren't just, waiting for the next venture round to come, but can build something sustainable and durable. And then how can we get those companies into the public market earlier, both again to help sort of Main Street, share in the growth of these businesses, but then also to unlock even more capital for the growth of those companies.
Great. Venture turnarounds, last one under the things shaped like an investment firm.
Yeah. And this is one that is, again, like, I can't say that this is a category yet, but it's one that I'm very interested in because of what you sort of said earlier, which is we haven't seen a supply of companies kind of get to that, industrial scale yet for a bunch of different reasons. And what that also means is that a lot of companies that have raised a lot of venture capital are sitting there with, still, maybe having runway, still having teams that are committed to seeing through the technology, but have sort of broken cap tables or some sort of structural disadvantage that is really going to hamper them. And where maybe, a lot of their investors have written it off or said, hey, this isn't going to achieve what we want it to achieve. And so, are there opportunities to go in and be very opportunistic and help to, take that technology out or, in other, to help to kind of re-spark those companies. And, again, it's not something I've seen a ton of times. It's not something that's easy to do. It's extremely, extremely hard to do. But I do think that as more of these companies actually start to get to some degree of industrial scale and have these distribution pipelines and have mature sort of technology platforms, there are opportunities for them to not necessarily do venture turnarounds, but that it becomes a better pipeline for bringing that technology to market.
Yeah, it makes me think of, obviously, like you've had this whole wave, this is the past 20, 30 years of kind of the corporate spin out, right? Go find these kind of nascent technologies or subsidiaries within corporations. And I forgot the name of the firm. It's an LA firm. It's Tom Gore's firm, Platinum Equity. They were the ones that really like normalized this of working with these spin outs. And so it's kind of this interesting one where it's like kind of a spin out from the venture firm that has a structural challenge, which I think most people don't realize there's a big wave of that coming. So it's going to be a very interesting time.
Well, and I think like, if you take the defense industry, for example, and you talk to people in the defense industry or, and I think this is a comment that people make about sort of the venture market as a whole is that, it would be nice. It might be more, more beneficial, might be more efficient if a lot of these, businesses that are out there raising capital and building technology would actually kind of join forces. If we could concentrate more talent behind, the biggest companies, the biggest, the most ambitious sort of initiatives. But that, that doesn't happen. And I think for good reason. Like, again, we don't necessarily know, you can't necessarily predetermine it's very uncertain which companies are going to succeed and how that's going to play out. But the reality is there's been so much venture capital, driven into companies that in many ways kind of look the same or are trying to go after the same things, but maybe have, a different twist on specific technology, or maybe as part of a broader platform can can add some component level value to what a company is doing. And so I think you will start to see, and this gets to a little bit of the other side of the coin that I'm sure we'll talk to on some of these roll-up models and things like that. But I think that becomes, an interesting way to, sort of capture value from some of the waste, so to speak, of all the venture dollars that go into the companies that don't actually succeed, is that they are building real technology value. In some cases, they are securing real contracts with governments or with, large customers. And so being able to bring those and consolidate those can be a way to start concentrating some of that talent behind the companies that are really succeeding.
Great. All right, let's go over to things shaped like a company. So the first one you have here, just Techno-Industrial holding companies.
Yeah, and I think that gets to a little bit of this model here, which is, how do you get really, really good at one specific thing and then build a bunch of other capabilities around that take advantage of that one specific thing and allow you to continue growing. And I guess, again, to stay on the defense example, the most valuable thing in that market doesn't seem to be technology. It seems to be sort of access and trust and being able to win those contracts, knowing who to sell to, knowing how to actually go through that entire procurement process. It's a maze, whether we're talking about the US or whether we're talking about Europe, it doesn't really matter. It's hyper complex. And so if you can be sort of that central distribution point and you can build the team around that, then you have this advantage of being able to go, build, buy, or invest in the different sort of capabilities or companies or technologies that you can then kind of push through that funnel. And so a company there, a relatively early stage company, but one that I find super interesting is a company called Valinor, which has sort of taken that approach a little bit of saying, and they're founded by General Catalyst and Trey Stevens and a couple of other people, and really taking that model of saying we have a massive distribution advantage. And so we can go build a distribution and capital engine to really scale these diffuse assets or diffuse companies.
It's so interesting. You mentioned kind of the GTM aspect. And I think a lot about this too, kind of with where all the tools that are being built now. This is more of kind of, I was saying, the smaller end of the market, or like actually to support startups, and kind of like you've heard this whole term of a GTM engineer now, which is like, it's like these new positions being formed. And yeah, I think I can see a world where all these different support systems, which are very different, that never existed before, can just be really additive to this kind of, like, as you mentioned, kind of mix of kind of operating support, investing, advising type model. I'm seeing it in some stuff that I'm doing. We're doing that with a few of companies, my portfolio companies, where we've been building kind of a bunch of automations and back office stuff to really help these companies. Less on the industrial side, but the physical, in the physical real economy.
Well, I've seen it in areas like robotics as well. And again, these are similar to what you're talking about, relatively nascent sort of endeavors, but, effectively saying, hey, if we can go build that distribution wedge into mid-tier manufacturers or into the agricultural sector and kind of be a dealer for that sector, then we start to sort of commoditize all the different technologies and capabilities and companies that want to sell into that market. And so we can then be that sort of go-to-market engine for those businesses, which, gives us the insight if we want to build something new ourselves, gives us the sort of advantage in a negotiation if we're looking to, acquire a technology or acquire a company that we can then push through our channel, and gives us the value add as an investor, as a minority investor in these businesses as well. So yeah, I think it's starting to happen across different categories for sure. And again, and I think I would probably put the caveat over all of these things is that, they are still all quite, early in their development, and the companies and the investors that are building these models are still kind of figuring out, again, going back to the very beginning, like what's the exact way to talk about this, to structure this, to execute this, that does make what we're doing or what they're doing very legible to sort of the traditional capital pipes that's going to allow it to really scale.
Sure. All right, so the next one, Digital capital markets orchestration.
So if we take something like robotics services that are being deployed out in the field, there's a really interesting sort of set of data, telemetry data, contract data, all of this information that is flowing off of these systems that has the potential to be used in underwriting and used, by companies or by investors to bring different types of capital to help those businesses scale. And so I think that is largely, what that is sort of getting at, and there's probably a couple different angles to that. Like, how do we build the marketplaces? How do we use this data to build sort of the marketplaces that unlock capital? So, what do the sort of angel lists of this, next generation, sort of look like? And there are companies like Crux Climate that are doing that in interesting ways, bringing together projects and capital providers. And then how do we build sort of the standards, the data standards, the metric standards, the benchmark standards to really start to understand these types of companies and these types of, physical distributed assets as asset classes that then allows for more capital to kind of come into that space.
Great. Growth buyouts.
Similar in some ways to the holding company piece, or similar in some ways to the, I guess the venture turnaround piece. It's really a model that, I think kind of sits at the intersection of venture and private equity, or, venture and infrastructure in some cases. But there is a world with a lot of these businesses where, the adoption dynamics are still tough. Maybe the customer bases are just too diffuse, or there's some, economic or cultural element that just limits the ability of a company to deploy technology into that market. And so, the ability or the idea of a growth buyout being using the technology that you've developed. It could be software, it could be sort of this hardware enabled solution, and basically saying, we're going to go vertically integrate and buy our customer. We know that this works. We know that we can operate this more effectively than others. And so we're going to, instead of trying to go and necessarily, build that vertically integrated piece, we can take a step forward, or we can leapfrog a little bit by, making an acquisition of a traditional player.
Yeah, you're acquiring distribution essentially, which speeds up the vertical integration. Okay. Super developers.
Super developers. A bit of the flip side, I suppose, of what we talked about earlier with those sort of gap capital providers, but effectively, companies that are not necessarily the most cutting edge technology businesses, but that have a real edge in being able to go actually put steel in the ground, build these projects, and might be doing that with sort of commodity hardware, commodity energy systems, things like that in the early days, but then can increasingly partner with more and more sophisticated hardware, sophisticated technology companies to bring that through their channel again, and less necessarily focused on owning those businesses and more focused on providing a service and being sort of the pathway through which new technology companies actually get to market at meaningful scale. And I think that's relevant in the energy space. I think that's relevant in robotics as well. A company like Cardinal Robotics doing this for the cleaning industry, so like hospitality and areas like that, basically getting very, very good at systems integration, highly efficient, and then highly efficient at deployment and execution on the ground, and then becoming, again, a go-to-market interface for a lot of the technology companies that don't want to or can't or are waiting to build that capability in-house.
Yeah, so you bring up the term sort of systems integrators. It's just so obvious. There's going to be so much interesting stuff that needs to be built on the. When you look at how systems integration works today, and it's nothing against the systems integrator, it's just like it's a hodgepodge of old technologies. I heard the stat. It was like in the robotics space, if you're looking to integrate a average robotic system, on the factory floor, a robotic arm, the cost of that robot, the integration cost of that robot is 6 to 12 times higher than just the cost of the robot itself.
Mm-hmm.
And I was like,
yeah, I've heard similar statistics, which, that's a huge, just sort of, economic gap or economic opportunity for these companies to fill, whether that's the technology company itself that's saying, hey, we're actually going to, we're going to figure out how to make it so that the deployment with these customers is extremely fast, extremely repeatable. We're going to do maybe the hardware systems integration on our side and then deliver it as a service to the customer so that there's effectively, no deployment lag and none of that massive deployment cost. That's certainly one version of it. I think, or just being that kind of next generation systems integrator that can do it much more efficiently. So yeah, I think there's a bunch of opportunities there.
All right, two more, then we'll wrap up with some rapid fire. And these are two of the areas that I'm the most interested in. So, industrial franchises.
I mean, it's funny, like franchise businesses and sort of venture capital or innovation are not sort of things that necessarily go hand in hand. But, some of the biggest businesses in the world, some of the most successful, very high margin, businesses, Domino's Pizza, things like that are franchise businesses. And, I'll use the example of a company that I know well called Isambard, which is still a relatively early stage company, but has sort of seen a big opportunity to build machine shops and to build manufacturing facilities in a very decentralized way, very close to the customer, whether that's an aerospace customer or a maritime customer or a defense customer of some sort, but building sort of real on the ground production capacity close to those customers. And the challenge with doing that in the past, and the reason that the sort of like machine shop manufacturing industry is so diffuse and so distributed today, is that centralization has won. That's how quality control has been done most effectively. Being able to bring all that machinery into one place, all of those kind of things, centralization has kind of won out. Now, with sort of much better data, with the ability to do procurement in a more decentralized way, or with software and the ability to do quality control across these places, a company like that and other companies as well see opportunities to actually build a more decentralized network of these facilities. And then, why franchising? What's sort of the value of franchising? Well, one of the really interesting things about franchising is that it is kind of this, new potential prestige career path to put people on. And, you can sort of, if you can build a machine shop in a box, so to speak, where you can set up really ambitious, talented people with all of the capabilities that they need to go operate a physical industrial business, and you can help them with the financing, and you can even provide some degree of support on the commercial side and the centralized go-to-market side, then it, becomes something that instead of going into private equity or going into consulting, you can attract really, really strong, talented people who want to be entrepreneurs to go and operate those businesses. And it gets to that sort of like Main Street aspect as well, which is like these types of companies have the potential to not necessarily create massive numbers of jobs in specific locations, because these are like generally going to be smaller factories or things like that. But they do become, a beacon of pride for a community that now has an advanced manufacturing facility in town, or, when they open it up, all the local community comes around and sort of sees what that company's building. So there's an element of being able to kind of more closely tie to the local community by doing that as well. So yeah, there are, not massive numbers of these models, but I do think sort of the, building a business in a box and unlocking entrepreneurship, whether it's in manufacturing or whether it's in the trades and sort of physical services, I think is a really, really interesting opportunity for a lot of companies.
I agree with that. It's super fascinating. And I think one of the things that I wanted to mention, which is very important, because I think kind of the traditional franchise model's kind of gone awry and it's become very much more extractive. And you can feel that just when you go into a franchise now, right? Where it's like, a lot of these franchise models, they've been they've been acquired by private equity firms. Then they're focused on kind of cost cutting, growing locations. And you walk in Like I went into a popular fitness franchise last time when I was visiting my mom in Michigan. And like literally I felt in like this like soulless place that it was, and then like I was getting like automatic text messages for the next 2 weeks, every day. Mm-hmm. And what's interesting about this new wave of kind of business in a box that I'm seeing is a very important one. And there's some very interesting models popping out, is actually how the ownership works as well. So I think that's one of the things that kind of this last wave of kind of the franchise model has kind of missed out on, as it's kind of turned into kind of this kind of much more extractive behavior and cost approach to cost cutting, and then, selling it every 3 to 5 years. I think there's something really compelling here. If you can actually, how do you give the individual franchisees also a component of ownership, or align their incentives long-term at the franchisor level?
Definitely.
And I think one of the things I'll mention here, then we'll hop to DePIN and then we'll wrap up, is you hit something that is so true, which is this kind of connection to local community. Because this is like my main motivation for going direct, which is, and it sounds abstract for many people, but it is so completely spot on. And because I come from a place where it was like this, where everyone on the baseball team or the basketball team, all the local sponsors were the local businesses, and a lot of stuff related to automotive suppliers and fabrication shops, and like all these local places that were really the fabric of the community. And I don't know, it's really, really important, man. And I unfortunately don't hear more people talking about it. I think 8VC and Joe over there is like a big advocate for this. I know they just launched it's called main shares, or a program. Mm-hmm. Yep. But man, it is so important if we're going to actually kind of strengthen our local community. So I'm glad, I appreciate that you said that.
No, totally. And I mean, it's, these are very kind of wicked problems and complex problems. One of the things that, I've talked a lot with people about right now, and this ties very closely to how we actually train and find the workers to go build these things or do these things, is this kind of this depopulation risk that we have in really the entire world, not even just developed countries, not just Western countries, nothing like that, but the entire world. And it's not that having sort of local communities that are economically vibrant and viable are the only solution to that. But if we do think that is one of the most critical risks to our sort of shared prosperity and economic growth over the next dozen or like next decades or 100 years, is this demographic inversion. Well, one solution for that is kind of reinvigorating the local community, building a stronger sense of place, and building the types of companies, the types of organizations that are actually invested in and committed to making those places thrive.
Sure. And I think it's a good segue into which most people don't connect this. It's like, you need to align your incentives of your business model with the outcomes that you want. But then there is this aspect of capital that people don't pay attention to. Like as we discussed before, it's if you don't put the right capital on the business in the right way, it will compromise a lot of times the mission or values of why you created the thing in the first place. And I think it's really important to mention. And I think it's another kind of point here that points towards there's going to be new things forming out of this stuff. So. Totally. All right. So DePIN, this one I'm like very fascinated by too. I think about it a lot in different ways, but tell people what you mean by DePIN.
So I can not claim to be an expert in any of these models, and this is the one that I'm probably by far the least expert in. But one of the things, this is really all around incentives, yes. and how do we remove much of the marginal friction to actually scaling these technologies and scaling these projects? I think I don't know if the number off the top of my head is exactly right, but if we look at sort of for every dollar that gets allocated from a pension fund, so sort of the top of the global capital markets food chain down to some sort of real asset project, I think only 60 to 70% of that actually makes it to the project itself.
Probably max.
Max. I think it's about 60%, and the rest is middlemen, it's consultants, it's, different types of regulatory review. It's, all of these things that are, in place for probably for good reasons, or because somebody lost money or somebody committed fraud, or, some real reason that this is in place, but it creates this massive drag on our ability to actually build things quickly and effectively and, on time and on budget. And so, one of the interesting things about sort of more sort of decentralized networks like this is that it does create sort of the opportunity to do things around, better project projections and pulling better data in around some of these projects to more effectively kind of understand, what the likelihood of something succeeding is. There are opportunities in areas like prediction markets to sort of pull that into the infrastructure world. And so that's one piece of it. And then I think the DePIN from just like a pure technology perspective is, again, how do we enable and unlock real autonomous action in the physical world with robotic systems and with other forms of hardware, where they go from being sort of either just passive sensors or taking direction from people to being actually agentic and being able to execute based off of what they understand and what they know. And part of that is being able to transact, in a trusted way, and to be able to understand things like location, and to be able to understand things like asset uptime and things like that. And those are all components of sort of this decentralized physical infrastructure and the networks underpinning them that could potentially play a big role there. But yeah, I'd be curious, I guess, on your side, what you've been looking at there, how you've been thinking about it.
I think similar to you, I'm far from spent enough time in it, or I'm not that educated to speak on it in very detail, but it's just so very clear that crypto and the rails around crypto and blockchain, that is the money layer for AI, robotics, and automation. Mm-hmm. Like, that's just obvious. And the area that I think I've been thinking a lot about, and I've spoken to a few folks in this, is how do you use kind of this incentive structure around like robotics training data, which I think is like really interesting. Going back to your piece, which is, it really just comes down to incentive structure. And the reality of it is everything that we're talking about is inherent. And if we want a more decentralized real economy, and we want this more decentralized world, that means like that we have to like be very, very efficient and create incentive structures that provide enough incentive for people to do the thing that within that ecosystem they want to do. So robotics training is one area that I've like really been thinking a lot about it, but I'm just fully convinced, obviously, that crypto and blockchain is the when you think about trust and verification, there's no other way. All right, we're ready for some rapid fire. Have some fun here. What's your favorite French cheese? Beaufort. It comes from the region around me where we live. It's like a hard cheese, pretty strong. It's the best. Favorite region for French wine? I will admit to ignorance around much of kind of the wine space. I guess Côte du Rhône is pretty good. So. All right, now we'll go back for Production Capital. Which Production Capital model is most underhyped that we've spoke about in your mind? I would say that we've had a big wave of, again, failures of, building infrastructure. People are very down on sort of what people refer to as like first of a kind financing and everything like that. And so we've seen companies like Northvolt in Europe sort of fail with these big projects. But I do think that, the firms that are bringing together sort of that venture discipline, or that venture sort of optimism with that infrastructure discipline, sort of the gap capital models, are going to be really, really important and successful. And so I think that would be one that is really kind of underhyped or is overlooked right now. Anyone that's overhyped or kind of oversupply, I would say. Probably a lot of, there's a lot of activity happening around sort of growth buyouts and how do we go roll up these traditional industries. And so
I still think that there are tons of opportunities there as companies look at, actually going and not just rolling up sort of your standard issue accounting firm or something like that, but actually operating in these more complex industrial value chains. I think there's still a lot of opportunity there, but I think that's an area that is being fished pretty aggressively by a lot of different groups right now across venture and, private equity and elsewhere.
Which type of founder thrives the most in this new world?
It's, going back to what we talked about around the need to, have all of these capabilities under one roof. I think that there are, the types of founders that can, if not be the expert, or if they're not the best person in the world for all of these different areas, that commit, very early on in the life cycle of the company to deeply understand all of those key pillars. Like, they might come to it from a technology background. It's critical that they go out and understand the financing piece as early as possible to know what the art of the possible is. Same with the regulatory piece, same with the actual areas and customers that they're going to be deploying these projects into or these technologies into. And so I think it's the founders that can move effortlessly through all of those different worlds and can build the competency to know what great talent looks like to bring into their company to go execute in all of those different areas.
What's missing from the mosaic that someone needs to start?
One area that is super exciting to me, and I'll sort of say that this is what I'm kind of working on these days, is how we bring asset-backed finance earlier on in the life cycle. So there's been a big focus on project finance for these businesses. How do we go build out the factories? How do we go build out the what does the actual end infrastructure itself look like? And then I think there's a lot of focus at the venture level of how do we build the actual technologies, the new production stack, the robotics, the electrification systems, the perception systems, all of this kind of stuff. And I think that there's a really, really, exciting ecosystem of what I kind of refer to as hardware enabled services companies that are growing. A lot of these companies are in robotics. They're companies like Gecko Robotics, which does infrastructure inspection, or they're companies like Zipline, or they're companies like Sail Drone, where these businesses are leveraging increasingly powerful off-the-shelf hardware, pulling it together in interesting ways, layering on software, using that as a wedge to get in and really own key workflows for their customers, which allow them to lock up long-term contracts on the back of hardware that has real residual value. And so, we've seen sort of this explosion of specialty finance and asset-backed finance in more traditional industries over the last several years, everything from, basic stuff like car loans and things like that to financing the royalties of music, or to financing salaries for football teams. And I think this is going to be a really, really interesting area where there's real contract value, there's real hardware value, and there's an opportunity to bring credit earlier in the life cycle to a lot of these hardware enabled services businesses.
Great. All right, and let's wrap up here. Tell folks a little bit more about what you're building, what you're working. Obviously, you told a little bit about it, but anything more about Production Capital and anything else you want to say, and how people could reach you?
Yeah, I mean, so this is still in the nascent stages, as so many of these different models are. I continue day to day to invest and work across this entire stack, either as an angel investor or as a venture partner in different areas. And yeah, the production capital that we're building is really focused on being the credit layer for the new industrial economy and for this infrastructure and industrial super cycle that we are going through. So in terms of finding me and knowing where I'm at, certainly on LinkedIn, and then I write on Substack at venturedesktop.substack.com.
Great. Well, we'll include that all in the show notes, and obviously a link to the your piece here about the mosaic. And well, listen, man, I appreciate it. It was fun, and I look forward to many more.
Awesome. Thank you.
Thanks, man.
Great to see you as always.